In this video, we are going to cover everything that you need to know about assumable mortgages. You're going to meet Mr. Richard Terzo, a 29-year real estate industry veteran. He's going to school us on all the financing side of things. We're also going to head out to the Paradise Resort, take a great look at a 4-bedroom, 3-bathroom unit, and run all your numbers, your gross rental incomes, your operating expenses, your appreciation, your depreciation. You name it, we're covering it in this video. Let's get into the video now. All right, guys, so in this video today, we're gonna cover assumable mortgages. And right off the jump, we're gonna let you know that an investor cannot assume a mortgage.
In most cases, definitely not.
Yeah, now, can you go into that, why they can't?
Oh, well, definitely. Most assumable mortgages are going to be your government loans, which are your VA, FHA, and USDA loans. And those loans are only intended for primary occupants. So they look at when you're assuming the mortgage as the same way they would as a purchase. So while you could take an existing home that has an FHA loan and turn it into an investment property, you can't purchase a property with an FHA loan and as an investment property.
Not gonna happen. So don't even try to do it. If somebody comes to you with some seller financing deal and tells you they can assume, you can assume their mortgage.
There may be some private mortgage that's out there that may be assumable, but it is few and far between, and I've never run across one.
In 25 years of being in the business in some form or fashion, 13 or 14 years in lending, he's never come across one, guys. So be leery of any seller financing deal where they're telling you you can assume the mortgage for an investment. I believe you should invest in oceanfront condos in Myrtle Beach, South Carolina, because you can enjoy and increase the passive income of your oceanfront condo through the 20 to 22 million tourists that visit the #2 vacation destination on the East Coast each year. Not only can you enjoy the equity paid for by visiting tourists, but you can also anticipate the over 100% appreciation experience at many of the oceanfront resorts in our market during the recent decade. I believe you should invest in oceanfront condos in Myrtle Beach, South Carolina, because you can depreciate them, reducing your overall tax burden, keeping more money for you and your loved ones, and ensuring unnecessary taxes aren't paid. Now, let's jump into the top 20 questions that first-time buyers or people in general might be interested in when it comes to assuming a mortgage. What is an assumable mortgage?
Okay, easy. It's a mortgage that allows a potential buyer to take over the payments and assume a liability for that mortgage.
Yep.
So most of the time, it's your FHA, USDA, VA loans that you see it most of the time with. And instead of having to establish a new loan, you're basically just taking over the terms of somebody else's loan. So, if they've got 10 years left on their loan, you're assuming those last 10 years at whatever rate or terms that particular person had.
So it could be a really good deal compared to getting a new loan.
Yeah, especially in this environment where we've seen rates are considerably higher than they were 5 years ago.
Yeah.
If you were to assume that person's loan, you would get that particular rate. So, you could be at 2.5%, 3% versus the 6.5%, 7% that we're seeing nowadays.
So cheaper interest rate, and if they've only got 10 years left on the loan, that sounds like a win to me. All right, guys, so we're on site, Myrtle Beach, South Carolina, at the Paradise Resort. I'm walking up, as you can see here. Now, right next door, we've got Grand Beach. We've also right there have the Grand Atlantic. And as you can see here, straight ahead, the beautiful Paradise Resort. We're going to head into a gorgeous unit today. Now, there's parking underneath the building, as you can see here. Your main office entrance is right here. And that's the entrance. and your front desk. Let's get in unit 802 right here at the Paradise Resort. Now guys, as soon as we walk in, you will notice a lockout unit right here. We're gonna get in that in a minute. First, I'm gonna show you the rest of the main unit. You have a closet with tons of fun toys for the guest. Now look at that beautiful flooring. Absolutely stunning. Beautiful, beautiful, beautiful. First bedroom here. Gorgeous decor, as you can see. 2 nice sized beds. It does connect to a Jack and Jill-ish bathroom. There's a closet here in the corner, as you can see. There is also that Jack and Jill bath. Again, that gorgeous flooring, tub shower combo. This is the community bathroom. It connects to the rest of the unit, which we're going to get into in just a minute. There is that stackable washer and dryer unit, great for those long-term tenants that are going to be staying, during those winter months, the snowbirds and retirees and golfers. Let's check this view out. This is the next bedroom. Nice ocean view, nice street view. You do have 2 beds, flat screen TV, again, a closet here in the corner, as you can see. And let's get into that kitchen. Beautiful granite, as you can see. Dishwasher, sink, refrigerator, stove, microwave. I mean, you have a full kitchen here, guys. Now, beautiful tray ceiling with a nice light fixture in the middle. Again, gorgeous decor. Check that out. Effortlessly flowing into the living room. The master is here. We will get to that in a minute. But look at the decor, guys. It is elegant and beautiful. Your moneymaker is right outside. As you can see, look at that. Tiled balcony. Absolutely stunning. Connects all the way down to the master, as you can see here. We're going to get there in a minute. Guys, that's your moneymaker right there. Oceanfront means beach and sand. Sand and ocean right at your feet. Here's some on-site amenities. Pretty cool. All the way down that coast. A gorgeous view, as you can see. Now let's get really quick into this master. Beautiful. Absolutely stunning. They want to hear the sound of that ocean while they're lying in bed. It's that simple and that easy, guys. Got your bathroom here. You do have a closet, as you can see here. Tons of stuff for the babies. And then, of course, that tub shower combo and bathroom. Now let's get into that. Let's get into that lockout unit. And it's got its own balcony, which we are going to get to in just a minute. First, I want you to take a peek at the room with me. 2 nice sized beds. Again, nice wall decor. You will notice crown molding up in the room. Flat screen. Tiled balcony. Let's just take a look at that view. It is ocean view right here from the side of the building. You can also see the street view. Well done, well done. And then this unit has its own bathroom. Again, it does have a mini fridge too. You'll see here, and its own restroom. Perfect for kids to hang out in. Multiple couples might want to rent the unit. They want their own space. There's lots of ways to do this, guys. And that wraps it up right here at the Paradise Resort. Anyways, so how is assuming a loan different from a traditional loan?
You still have to qualify for the loan. So
Okay.
you still have to work with the lender servicer that currently services that particular product to qualify. Each servicer may have slightly different qualifications, but you are going to have to meet credit and income requirements and any other requirements that you would for initially purchasing it typically.
Okay. Now, I know that you mentioned that most VHA, VA, and USDA loans are assumable.
Yes.
However, conventional loans are generally not assumable.
Conventionally not, and some older government loans are not as well.
So is a VA loan assumable by a non-veteran?
Oh, actually, yes, it is.
Get out. We're all learning. We're learning something today, all of us.
Yeah, so you don't have to be a veteran to assume a VA loan, which is fantastic, and that may work out great, for the incoming buyer. But it may be a little bit trickier for the veteran that's exiting the property. So one of the things we have to talk about is on all of these, one, we have to get a release of liability for the seller, so that basically if the new buyer defaults on the loan, the seller is not held accountable for it.
No doubt.
So it's really important that they get that release of liability. But on VA, on top of that, you need to be able to release their entitlement.
Okay.
VA loans, they're only allowed to use that in most cases up to a certain amount. So if you're not a veteran assuming it, then that veteran who's exiting the property, their entitlement is still being taken, for that particular property. So when they go to purchase their next property, they may not be able to get 100% VA loan on it if they don't have the remaining entitlement in order to do it.
It can get a little dicey.
Yeah. So when a veteran assumes a VA loan, then after they've assumed the loan, the VA, they have to request it through the VA to release the entitlement or switch the entitlement to the new veteran.
Okay.
And then that way the exiting veteran can go off and buy their next house.
Exactly. All right, guys. So we are leaving the front desk, and we are heading to the on-site amenities. This is the parking deck underneath that you pull into the front. This is a good time to tell you guys, April through September is peak season. That's when you're going to make the bulk of your rental income for the year. June, July, and August being obviously the top 3 months. You should make enough profit in those 3 months to basically cover all of your expenses for the entire year. Now we're getting into some of the on-site amenities. As you can see, there's a hall here. This is Sandals Cafe and Bar. It's currently closed, but you can see they do have a nice little cafe and bar, which is super cool. Sandals. We're gonna come in here, guys. Nice ramp there, handicap ramp to the left. And we're starting to get to some of the on-site amenities. Now you got amenities here, but you also have amenities over to the right. I'm just gonna show you really quick the lazy river. Very nice, super cool, nice hot tub right there in the middle, as you can see. Plenty of seating and chairs, which is super cool. Tables and stuff for you and your loved ones. Nice cool bridge, super cool. And then you got some more pools and hot tubs and stuff over here. You do also have, which is really cool, a life-size chess set. You see in that corner there. And guys, there's your final pool here. Now, I'm going to take you outside so you can check out the outside, the outdoor pools and outdoors amenities. These are all indoors. Ta-da, we're here. So you got a pool to your right this way. Plenty of places to lay out over here towards your left. And then you've got beach access right there. Let's check out this pool here. As you can see, beautiful sunshine. Guys, it is January 29th. It feels great outside. I don't have a scarf on. I don't have a coat on. I don't have a jacket on. I have a suit on just like normal, and I'm enjoying this beautiful weather. As you can see here, there is another patio where you can lay out and get some sun, and people are doing that right here in January, which is super cool. Super cool. Now, as we mentioned already, you have a whole nother deck to lay out on over here, which is cool. And that, ladies and gents, that building right there, that is the Paradise Resort. Now, Really quick, I want to show you the beach access. You do have showers when you're coming off of the beach, which is super cool, as you can see here. And of course, the one and only Myrtle Beach, South Carolina, right here. And that's what you're paying for. That's what your guests are paying for. They're paying for that sand and that ocean to be right out front of that gorgeous building right there. Now, let's talk about some of the benefits of assuming a mortgage. Now, you obviously inherit, as you already said, the original interest rate, which of course could be lower than the current interest rate, which is super huge.
Yeah, you wouldn't want to assume it in most cases if it's not.
Exactly. Now, you also get lower closing costs compared to getting a new loan, which is obviously a huge plus. You're saving money. Now, there's also no need for a new appraisal in many cases, which again reduces your cost. And then potential for easier approval when compared to a traditional loan. So kind of walk them through why it would be easier to get approved for an assumption as opposed to a brand new loan.
A lot of that is just really based on the interest rate.
Okay.
You know, if you're trying to get approved at a 7% rate versus a 2.5% rate, then your debt to income ratio is going to be lower, and that's going to help you get approved for that particular property. Also, the down payment, which could be a tricky subject, but if you have equity in that property, then that's going to help with the approval because it looks like you're going to have more skin in the game.
Okay. All right. So, are there any risk with doing an assumable mortgage?
I wouldn't say there's any more risk than you would have with doing a normal mortgage. You still have to go through a lot of the same hoops, verifying your income, verifying your credit. They're going to still want to see that your debt to income ratio is going to support that housing payment. One of the things that we might want to talk about a little bit is the difference in equity that is in that particular house. And I don't know if there's a separate question about that.
Let's go for it.
So when you're assuming a loan, so we talked about possibly assuming a loan that's only got 10 years left on the mortgage.
Yep.
Well, that person's already been paying on that mortgage, let's say 20 years. Okay. So that person's built up a good amount of equity in that property.
Yep.
They typically are not selling that property for whatever the balance on their mortgage is.
Okay.
So if they only have $100,000 on their mortgage and they're selling the house for $300,000, you're going to assume that $100,000 mortgage, but you're going to have to still come up with a $200,000 difference.
Okay, let's keep going.
And that can get a little tricky because a lot of times, people don't have that much money sitting around. So when you're looking at homes that are offering assumable mortgages, not only do you have to look at what the rate is and if they're assumable, you have to look at how much you're going to have to bring to the table, because if somebody bought the house in the last few years or the house is depreciated in value, you might not need very much money, whereas if the house is, if they've had that house for a while and the house is greatly appreciated, you're going to have to bring a larger down payment.
Okay, hold on. So you're telling me if someone doesn't have that $200,000 difference from the assumable mortgage, they're still going to have to go get a loan for it.
Yep. And that can get a little tricky in and of itself.
So now you've got a house with two mortgages.
Yes.
One cheaper, hopefully, a lower interest rate, hopefully, with less due on it, less amount of time, and then a brand new one for maybe that full 30 years.
Yeah, so you're still saving money. If you get a $200,000 mortgage that's at 3% interest rate, and you got to go out and get $100,000 at 7%. Even if it's like if you're looking at a second mortgage or equity line, the rates tend to be a little bit higher. So it may be 8% or so in today's market, but you're still overall paying a lesser combined interest rate than you would if you went out and paid $300,000 at a 7%.
So, and I'm going to backtrack real quick because something you said caught my attention. You said if the house is appreciated, they may have to pay a larger down payment when assuming the loan.
Well, yeah, because if somebody bought the house for $200,000 10 years ago and it's worth $400,000 now, who's going to sell that house for $200,000? They're going to sell it for the $400,000. So they may only have $150,000 mortgage left on it, but they're going to sell it for the $400,000. means you got to come up with that extra $350,000.
Yeah, no doubt.
But you can get a second mortgage for it. Now, you have to work with the current lender because that mortgage is still going to have to be subordinate to the current mortgage that you're assuming. So it has to take a second position. So typically it's going to be a second or a HE loan or HELOC that you're going to get on it. And there's advantages of going those different routes. And you don't necessarily have to use the same lender for that product. You can have one lender doing the HELOC and assuming the mortgage that is currently being serviced by a separate lender.
Okay.
But they do have to kind of work together. They have to be aware of each other. You know, they have to know that you're going to take on, you know, this debt and make sure they position. Because if you don't, you know, if you try to go out and take a HELOC and you're at the same time, you know, you've assumed this other loan, then you can trigger the due on demand clause, which then the loan that you've assumed now is going to come knocking on your door wanting you to pay it off.
Okay. Question for you.
Yeah.
If you assume someone's loan, can you turn around after assuming that loan? Let's say that you're selling your house, you're buying their house, and you want to assume their loan. Can you pay down $200,000 on their loan that they have left? If they, you know, let's say that they've got a $300,000 loan. You assume it. Can you turn right around? You sold your house. You got an extra $200,000 out of the sale of your house. Can you assume their loan and then turn around and pay $200,000 down on their loan and then maybe refinance their loan or
Well, I mean, you wouldn't want to refinance their loan because then it's the same as if you're purchasing it. You're doing away with it. Yeah, it makes no sense. Now, most all of those products, or I would think any of those government products, do not have a prepayment penalty.
Okay.
But you would want to check with the servicer first, so you can put any amount that you want towards the principal without any kind of penalty on it.
Okay.
So yeah, if you wanted to throw another $200,000 on it after you have assumed it, you could.
Cool.
You know, and they may actually allow you to do it during the assumption process. You would have to work with that servicer.
Super cool, super cool.
Yeah.
Now, are there high assumption fees compared to getting a traditional loan? Are there any hidden fees? Are there high fees? What's the deal there?
They do charge fees. I wouldn't necessarily call them high fees because yes, the assumption fees could run $500 to $1,500. However, if you are going to go get a new loan, most likely you're paying origination fees that are gonna, you know, be in that same range anyway.
Yeah.
So it's comparable.
Okay.
And you may save money on other charges and other fees, attorney's fees and things. So it may actually even work out cheaper doing the assumption versus
a brand new loan.
Yeah,
All right, guys, so let's cover a cash scenario purchase right here for the 4-bedroom, 3 bathrooms that we walked in and toured earlier. Now, guys, that 4-bedroom, 3-bathroom over the last 24 months had a purchase price of $575,000. Your average gross rental income between 2022 and 2023, we found the highest performing unit in the MLS at $91,775. Now, do I believe that the unit could do more? Absolutely. Do I think it can bring in up to $120,000 in a year? Absolutely. Do you have to be at the top of your game to bring in $120,000 a year? Absolutely. You can't buy an old dated unit and expect to bring in the big bucks. Now, for Airbnb platform fee, that's 3% of your gross rental income. So 3% of $91,000 and some change is $2,753.24. Now, if you subtract that $2,753.24 from the $91,775 in gross rental income, you're left with a subtotal of $89,021.31. Now, your taxes in 2023 for a property like this, the 4-bedroom, 3-bathroom here at the Paradise Resort, was $5,327.40. Your cleaning services were $7,500. We've got you based on 30 cleanings at $250 a cleaning. It could be less, it could be more. Depends on your rental strategy. If you only allow for 1-week rentals, probably going to have a lot less guest turnover as opposed to allowing for 1 to 2 day rentals. Now, and why you might do that is because you want to get as many reviews as possible on Airbnb so that you can become a super host and have a lot of online credibility. Anyways, that's for another video. So, your excise tax was $679. Guys, excise tax. It is a base fee of $145 for your first $2,000 in gross rental income, then $6 per $1,000 that you make in gross rental income thereafter. That fee goes to the city of Myrtle Beach to own and operate and have a business license in the city of Myrtle Beach for a short-term vacation rental property. Now, moving right along, your next line item here is, bear with me guys, bear with me, it is your local hospitality and accommodations tax. Now, that was $2,753.24. That's 3% total of the gross rental income. 1.5% goes to the city of Myrtle Beach. 1.5% goes to Horry County. You do need to make sure that the platform that you're using does collect all your taxes. Some of them don't collect all of your taxes. Some of them do collect some of the taxes, but not all the taxes. You need to make sure you verify and find out what taxes you are responsible for paying. Now, next, we got your annualized HOA dues. That was $22,848 for the year. Now, if you subtotal all of those recent operating expenses, it brings you to $39,107.64. By subtracting that $39,107.64 from the $89,021.31 subtotal up top, you are left with a projected profitability, yes, of $49,913.68. Wow, that's a lot of profit. And if your unit just made $5,000 more, we're talking about $54,000 in profit. Now, I've got you at a 57% cash on cash return. What I've done is I have basically accounted for your annual profitability, your annual tax deduction for depreciation, and your appreciation on this property over the course of the last 9 years. So we're going to get into all those other factors up front, and you're going to see how these properties can have such a high cash on cash return.
Are the assumption fees, or excuse me, are the lending requirements cheap or easier for an assumption as opposed to a traditional loan? Like, can somebody get in with like a 600 credit score on an assumption, but maybe for a brand new loan they'd have to have at least a 640, or what's the
No, typically they still have to be able to qualify for the mortgage for whatever that servicer's guidelines are. So when it comes to things like the FHA loan, FHA and HUD does not set like a minimum credit score. The servicer does.
Yeah.
So while some servicers may require a 620 credit score, other servicers may go down as low as 500 on a credit score.
Okay.
With the FHA.
It depends.
So you have to work with that servicer, and you do have to qualify under their
So it depends.
guidelines.
It depends on the loan type. VA is going to have a different set of requirements as opposed to FHA. Anyways, and so forth and so on. Yeah. So, all right. How do we find properties with assumable mortgages?
Well, that would be your department, your wheelhouse.
You call me on the phone, and I'm going to hunt the MLS to find you your deal.
Yeah, one of the, like I said, most any government loan in the last 10 years is assumable. So, if you've got the ability to go back and look at what houses had USDA, VA, or FHA, and I would think listing agents, when they're listing those houses,
Don't put it in there.
that would be a great marketing tool right now to help get houses sold.
All right, so let's quickly cover a financing scenario here at the Paradise Resort on a 4-bedroom, 3-bathroom. Again, that average purchase price over the last 2 years was $575. Your down payment, which is 20% of that $575, was $115,000. We've got your gross rental income at $91,775. We've got your Airbnb platform fee at $2753.24. If you subtract that $2753.24 from the $91,000 in gross rental income, you are brought to a subtotal of $89,021.31. Your principal and interest at an 8.25% interest rate for 30 years on your loan for this property was $41,460. Now your property taxes were $5,327.40. Your cleaning services were $7,500. That's 30 cleanings at $250 a cleaning for the year. Your excise tax was $679. Your local hospitality and accommodations tax, again, 1.5% to the city of Myrtle Beach of your gross rental income, 1.5% to Horry County for your gross rental income, puts you at $2,753.24. And your annualized HOA dues were $22,848. Guys, bringing you to an operating subtotal of $80,567.64. Now, if you subtract the $80,567.64 from the $89,021.31 subtotal up top, you are left with a whopping $8,453.68 in profit. If your unit just made $5,000 more, that jumps up to $13,000, and if it made $10,000 more, it jumps up to $18,000 in profit. Do I think those numbers are absolutely achievable? You better believe it. 4-bedroom units can easily bring in $120,000 a year if you're at the top of your game and you got a fully updated unit and you're running an excellent service. You have a lot of hospitality. Now, I've got you at a 46% cash on cash return. That does take into account your $8,000 annual profit, your appreciation over the last 9 years, and your tax write-off. So your cash on cash essentially is the money that's coming in and the money that you've got invested in the deal. So I've encapsulated even your tax benefits to calculate that cash on cash return.
Question for you. Do you know the specifics of the different types of loan programs, like the minimum credit score at least? For like a VA loan, they want to assume.
Again, that's going to all be set by the individual servicer. I can tell you what my bank does.
Tell us your bank.
With FHA, we can go down as low as 500.
Guys, 500. I know people are like, what? 500 credit score, I can get a loan?
Yep. VA, we can go down as low as 580.
Yep.
And USDA, we can go down as low as 620. Again, there have to be compensating factors. So, you know, the better the credit score, the less compensating factors that you're going to have. But if somebody's got a good amount down, they've got extra reserves in the bank, a really low debt to income ratio, then that's going to allow you to go with lower credit scores.
Are you going to need less or more cash when you're assuming a loan compared to a traditional loan?
Again, that depends on the equity in the property, what you're buying it for, and the loan size. Because again, you know, if you're buying a $400,000 house that has a $100,000 mortgage on it currently, then you're going to need to bring $300,000 to the table. If somebody just purchased the property and they've only got 5% equity in it, then you're going to get in it for 5% down, pretty much the same thing that you would typically.
So, are there certain loan types that are easier to assume as opposed to others? Like, are FHA loans easier to assume than VA loans? Like, what's the, what would you say would be the easiest?
Yeah, from a buyer's perspective, they shouldn't have to jump through too many more hoops. From a lender's perspective, what happens, goes on behind the curtain, then yeah, there are a little bit more obstacles when you're dealing with USDA and FHA, or USDA and VA. But from a buyer's perspective, it should be a lot of the same paperwork. It should be, a lot of the same qualifications. The biggest thing I would say was, after the fact with VA, then the bank and the seller have to work to try to get the entitlement switched. And with any of these loans, you want to make sure that the seller is released from that liability, which is a little bit more hoops.
Let's talk about depreciation here on this 4-bedroom, 3-bathroom unit at the Paradise Resort. Guys, $575,000 purchase price divided by 39 years brings you to an annual income, a taxable income deduction of as much as $14,743.59. Now, if you are a high income earner, you might want to consider a cost segregation study. Guys, you could be writing off as much as $30,000 in your first year. You need to get with a CPA that specializes in cost segregation studies for short-term vacation rental properties. All right, let's cover your appreciation here at the Paradise Resort. Guys, we're talking in 2015, the average purchase price was $312,000. Now, if you would have bought a property then, it would only been $312,000. You fast forward to 2024, that same property is $575,000. We're talking about $263,000 in appreciation. Guys, that's almost $26,000 a year. Wow. I mean, on top of the $8,000, $10,000, $15,000, $18,000 you're making in profit every year, you're also collecting almost $26,000 a year. in appreciation. And then with that $14,000 tax deduction that you can write off, guys, we're talking about a good cash on cash return here. Wow.
Yeah. Okay, so let's run through the mortgage assumption process. So guys, 5 simple and easy steps. Don't forget it. 1, you find a seller with an assumable loan, aka you pick up the phone, you call me, you text me, and I start hunting the MLS for you. 2, we apply with the lender for approval.
I'm going to say the lender. It has to be the lender
That
is
originated
there's-
the loan.
Not originally, because the servicing can get sold.
Okay.
You know, a lot of people, 2 months after you've closed on a loan, you closed it with,
Century
Cornerstone even,
yeah.
and next thing you know, Mr. Cooper is saying, "Hey, we've got your loan. We're servicing it now."
Hey,
So you've got,
yeah.
So whoever is currently servicing your loan, you have to work through them to get approval.
You're going to apply with the lender that's currently serving the loan. That's number 2. Number 3, you're going to provide financial documents, i.e., credit, income, and debt info. Finally, number 4, you're going to negotiate the equity payment with the seller. Can you break that down a little bit?
Well, that's just coming up with the purchase price. Let's say the seller again, has $100,000. So now you've got to decide, how much that seller is willing to take for that property. Are they willing to take $250,000, or are they willing to take, $300,000 for it? And you're going to have to come up with that difference between their mortgage and.
Again, you're going to consult with your agent. In your opinion, if somebody is marketing the fact that they have an assumable loan, do you think they're desperate to get the property sold?
I would think it would be smart for anybody. That's more of a real estate, question.
I think that's a good sign that they're hungry to get that property sold. All right. So number 4, negotiate the equity payment with the seller, and then number 5, you're going to close the transaction and take ownership. Is the length of, and how long does it typically take to assume compared to a traditional loan? What are you thinking? Same time frame?
I would think it'd be pretty quick. I would think you should be able to do those in under 3 weeks.
Okay, super cool.
It again depends on the servicer. Sometimes you're working with some of these bigger companies that service some of these loans, and the bureaucracy can drag it out a little bit longer than it should.
Yeah, no doubt.
Yeah.
All right, so let's just cover this one last time. Can I assume a mortgage for an investment property?
Most cases, I would say 99% of the time, no. Now, you can assume a mortgage as a primary residence or as a primary residence and then switch it to an investment property, but you can't do it at the time of assumption. It's only done after you've assumed it as a primary. Then you can, if you decide you want to move out of it a year later, then you can switch it over to an investment.
I believe you should invest in oceanfront condos in Myrtle Beach, South Carolina, because this is the fastest growing area out of the 150 most populated areas in the entire United States for the last 3 years in a row, according to U.S. News and World Report. This helps to insulate our market from many of the ups and downs that the rest of our nation's real estate market experiences. This can help you have a more stable rental property. I believe you should invest in oceanfront condos in Myrtle Beach, South Carolina, because they have a tremendous upside when compared to money market accounts and the stock market, due to the appreciation they earn and the potential of higher annual yields through their gross rental income when compared to these other investments. Money market accounts and the stock market don't have the upside of added appreciation. I believe you should invest in oceanfront condos in Myrtle Beach, South Carolina, because while our prices have risen and have held their value, we're also much cheaper than other places like Florida. Where else can you go and find an oceanfront condo for as little as $100,000? If you're getting into the real estate game or expanding your current portfolio, the bang for your buck is sitting right on the Myrtle Beach, South Carolina oceanfront.
Okay, so now what are your thoughts on older VHA and VA loans that might allow for some assumption?
I hear tales that they can allow for investment. I don't know of one, and as far as I'm aware, it is not allowed at the time of assumption.
All right. And I know this one might seem simple, but somebody probably has this question. What happens if interest rates rise after I assume a mortgage?
Well, if you've assumed a mortgage that has a fixed rate, then
You're set, right?
you're set. You're kept at that fixed rate. Now, if you assume a mortgage that has an adjustable rate,
Then you are getting impacted by that rise in interest rates.
yeah,
Ain't no way around it.
yeah. And again, probably don't want to assume a adjustable rate mortgage anyway.
Hello. Now, unless you plan on having it paid off in 5 years or something, and you got the cash, right?
Yeah, I mean, again, you have to look at the individual terms on it.
For sure, no doubt. After the rates drop on a fixed loan, on a fixed rate loan, is it smart to refinance an assumable loan? Can they do that?
Yeah, I mean, once you've assumed the loan, then basically it is your loan, and you can go ahead and refinance it if you want. I don't know if it would make sense. I mean, it depends on the math. You know, how much are you having to finance on a second loan? What's that rate look like? And at the end of the day, if you wrap the first in that, are you gonna come out ahead? But I don't think there's any rule or policy that once you've assumed that loan, it's just like if you had purchased it. I think most banks typically want you to wait 6 months or so before you would go refinance it. But at the same time, if you wanted to, you could refinance it.
All right, guys, let's cover some of your occupancy, average daily night rate, and some information from AirDNA. Now, I've got you booked at a 4-bedroom unit with being able to sleep 10 people. That's 2 people per bed, and then 2 additional people sleeping on the sleeper sofa in the living room. So I've got you for a head count of 10 people. Now, at that rate, your AirDNA projection shows $105,000 in gross rental income for the year. It shows a 71% occupancy rate for the year. So you can see that there is a little bit of growth potential on the table. You can see where, according to AirDNA, if you get that occupancy up to maybe 85 or 90%, you could be bringing in $120,000 a year. Now, I will throw out a quick caveat. If you are hitting 90, 95% on your occupancy, well, that's a good indicator that you need to start increasing your prices because you have substantial demand. But again, that's something for another video. Finally, guys, I do want to throw out that your average annual daily night rate was a whopping $407 per night.
Guys, let's cover the biggest mistakes investors make with assumable mortgages. And again, this is if you can, as an investor, assume an older VHA or VA loan. But really, this is opened up to anybody. Anybody that plans on assuming a loan, you need to watch out for these mistakes. Not verifying the seller's liability release.
Oh yeah, definitely. And again, that's just really protecting the seller on the back end.
No doubt.
If the buyer up and defaults on it, you don't want the bank, 5 years after you've sold the house, coming knocking on your door.
Saying you owe me.
Exactly. Yeah.
Overpaying for a property with too much built up equity.
Yeah. Again, if somebody is letting you assume their mortgage, they may be wanting a prime, top end dollar amount for the sale of their property. So does it make sense to pay somebody $10,000, $20,000 more for their property to get the lower interest rate when you can buy the same house down the road, pay a higher interest rate, but get it 20 grand cheaper?
Come on,
you got to do the math.
You got to weigh those things. Ignoring the assumption fees and closing cost.
Definitely don't want to do that. Again, those are all set by the servicer and the third parties that you're going with. You want to be aware of those and how much those are going to cost you. Shop that, and again, make sure it makes sense.
Now, this next one is a big one in my opinion, and I want to hear your thoughts on this. Not getting lender approval before negotiating terms. How do you do that? If you're putting a contract on it up front, how do you?
That can be a little tricky, huh?
I mean, as a buyer, if you're buying the property with a contract and you're ratifying a contract, but you've not had time to go through the financing terms of the So you would want to make sure that you ask for the financing, for the terms of that loan and everything that relates to it before you ratified that contract. Or you would write in, like in the South Carolina contract, in my opinion, you would write in Section 28 a stipulation stating that you get to review these terms for 3 days or 5 days or whatever, and or have your attorney or CPA look over it, or your financing person, to make sure that you are making a savvy investment or a savvy decision.
Yeah. And it gets tricky because it's not like you're working with your own lender that you can take to any house. You know, when you're going to write a contract, now all of a sudden you've got to find out who their servicer is and who you have to go through to get approved.
Call them.
Yeah, call them and start the process with them, which could take a little while.
No doubt.
You know, it's probably good to at least go ahead and talk to a lender up front. Make sure, you know, it doesn't look like you're going to have any issues, you know, getting approved. And then when you find one of the servicers, at least you have the assurance, you know, if you can get approved for a loan at, you know, today's rates with less down, or, you know, then you shouldn't have a problem getting approved, you know, with that lender with, you know, better rates and just assuming that particular loan. But there could be several things that might disqualify you. So it's good to get with that servicer right away. But again, you know, how far along with that process do you want to go before you've negotiated a contract to purchase the property?
And that in the state of South Carolina, that might be a very good time to use your due diligence period. You know, you can specify, I want 10 days, I want 15 days. And then let the agent know, hey, we need some time to talk to the servicer of the loan so we can make sure that all these terms are going to work out well for us. Super simple, super easy. You do have an option in that due diligence period to terminate that deal. So you can, you know, give a notice of a termination and pay a specified fee when you make that offer. So that way, you know, if things don't work out well after you talk to the service provider, you just pay your fee, have your agent drop that notice off, and you are out of that deal.
All right, so let's real quick run through maybe your top 5 attractions nearby the Paradise Resort. Guys, we've got the Myrtle Beach Boardwalk and Promenade. It's only 2.5 miles away. We're looking at a whopping 8-minute drive, which is awesome. A cool stat about the boardwalk is that it stretches 1.2 miles using the oceanfront and was ranked among the nation's top boardwalks by National Geographic. You definitely want to check it out. It's pretty cool. Number 2, you got the Skywheel. You know, it's 2.7 miles north. Your driving time is a whopping 9 minutes. A cool stat about it is it's 187 feet tall. The Skywheel was the first observation wheel of its kind in the U.S. and offers a panoramic view of the coastline. You don't want to miss that. And Myrtle Beach happens to be known for it. People see it. You see it in pictures with our beach all the time. Ripley's Aquarium of Myrtle Beach. You know, you're whopping 3.5 miles north from Paradise, roughly 10-minute drive. The aquarium features a 750,000-gallon shark tank with a 340-foot-long glide path allowing visitors to experience marine life up close. You can literally go in through it and be looking at fish and all kinds of stuff all around you. It's pretty cool. Number 4, Broadway at the Beach. It's roughly 3.6 miles north. You're 11-minute drive. We're talking, you know, it's the entertainment complex here that roughly spans 350 acres. It is gigantic. It attracts roughly 14 million visitors annually. You do not want to miss it. It offers shopping, dining, and all kinds of activities, festivals. I mean, you name it, it's out there, guys. If you're a couple, a single person, a family, there is something there for everyone. Now, Myrtle Beach State Park is number 5. It's roughly 2.2 miles south. It's around a 5-minute drive, and it was established in 1936, which is super cool. It's South Carolina's first state park, and it encompasses 300 acres of maritime forest and unspoiled coastline. Those are your top 5 attractions right here nearby the Paradise Resort in Myrtle Beach, South Carolina.
Let's talk about assuming a mortgage that is in foreclosure.
Okay.
Any kind of crazy, I mean, should somebody do that? Is that a little bit, you know, is that a little risky?
I mean, there might be some legal risk there because, yes, the current lender, that you're assuming is they're going to want the mortgage brought up to date. So, you need to know how much is, currently past due, what the fees are going to be, what it's going to cost to bring that up to date, who's paying that, and if you're buying it from somebody who hasn't been able to make the payments and has gone into foreclosure, are they going to end up paying that, or are you going to have to pay that? And which you could work out. I mean, as long as you can make the bank whole and perhaps pay the person less for the house. So let's say the house is worth $400 and they owe $25,000 to make the bank whole. If you only offer them $375 and assume their loan, then basically you've recouped your $25,000 in the equity. I mean, I don't know if that makes sense, but I mean that's up to you guys to negotiate and come out with what works. But you definitely want to know what it's going to cost, at the end of the day, to make the bank whole and to have a clean title.
In your opinion, does a buyer have more bargaining power negotiating on assuming a loan that's in foreclosure?
Well, I think if you're, anybody's facing foreclosure, then at that point, you definitely have some leverage, whether you're assuming it or not. So assuming the loan may just be an advantage, at that point to really take advantage of. But if somebody's on the precipice of foreclosure, then
could be a win.
Walking away with clean credit is a big win for them.
Yeah. So how many of those type circumstances have you seen in the last 13 years?
Prior to the last couple of years, assumptions have not really been a key factor in the business because rates have been so low. Why would you need to assume somebody who bought a house in 2005 was paying 5-6% when rates were 3% for so long? So it really left the business for a long time there. Now we're seeing in the last couple of years a resurgence of it where more are assuming those type of loans. And honestly, I've not come across one where they're coming into foreclosure. And I think a big reason of that is people have, housing prices have gone up so much in the last few years. People have so much equity in their houses right now. I think foreclosure rates are really low at the moment, and people are either able to pull that equity out to, pay their bills and, keep the, ball going, in the meantime, keep those plates spinning, as they say. Or they're able to sell the house just because we're so low on inventory that houses are selling really quick. So they're able to get out from under it, by selling it before they go into foreclosure.
That's a whole situation.
That's a whole nother video right there.
Right? Come on. So guys, you heard it right here. Richard Terzo, he's been in this industry now in some form or fashion as a builder, as an agent, as a lender for the last 13 years. He's been in the business for over 25 years. He has tons of 29 years.
29 years of real estate, industry experience.
Guys,
real estate broker, builder, appraiser, own construction companies, and been doing mortgages for 13 years now.
So if you need to get in contact with a competent lender that can actually answer your questions and give you some solid advice, Richard Terzo right here. Give me a call. If you're looking in our market, you want to buy an investment property, maybe a Myrtle Beach Oceanfront condo, maybe a commercial property, whatever you are looking for, 843-360-1737. I'm the broker that's going to help you, and I've got your financing guy right here. I have a full team.
CarolinaLender.com.
I got a full team and a network that you're going to get plugged into, from contractors to transaction coordinators to attorneys to inspectors. Everything that you need to get your deal done. I can take you from zero to done in no time.